Welcome to Fear and Greed, the week ahead. This is where we take a look at the big events, reports and releases coming up this week that give insight into the economy. And a look back at what happened last week too. I'm Sean Aylmer, and every Monday I'm joined for the week ahead by economist Stephen Koukoulas. You'll find him at thekouk.com and on Twitter using the handle thekouk. That's THEKOUK. Stephen, good morning.
Good morning, Sean.
So last week, the wage price index from the Bureau of Statistics, that was a cracker. I like that story.
There's a bit for everybody in it, I think, because, of course, we've got wages still below what the Reserve Bank would like to see. So the annual increase in all wages was 2.2%. So it's still a fair way from the 3 to 3.5% that the RBA would love to see. But when you cut the numbers down a little bit, you can see that public sector wages, which of course have been subjected to a lot of wage freezes from the state, the federal governments, the territory governments, they were really, really weak. And private sector wages, which of course are more linked to market forces, actually rose by 2.4% over the year, which was equal to the highest reading since 2014. So again, it's not the sort of thing that's going to be sort of celebrated that wages growth is finally, bursting forward, but it's double what it was a year ago when annual wages growth for the private sector was 1.2%, so we're at 2.4%, and the momentum still seems to be more up than down. So a hint of optimism for those of us looking for higher wages to sort of be an indicator that the economy is doing pretty well.
Now, Phil Lowe, the Governor of the Reserve Bank, earlier last week, ahead of those wage numbers, came out and reiterated that he didn't think that interest rates would need to rise until 2024. That's a central case scenario. He also said that wages was actually the key difference between what the Reserve Bank is thinking and what market economists are thinking.
Yes, it was a good speech. And look, he covered all the bases. And I think it just, as you alluded to there, it boils down to the assessment on how quickly we get to full employment. And that probably means unemployment at 4%, maybe even a touch lower, 3.75% or something like that. And then what that means for wages. Will we see, as the Reserve Bank is forecasting, the 2.2% goes to 2.5% in the middle of next year, goes to 2.75%, and then finally hits 3% in 2023. And that's when they start talking of rate hikes in 2024. Or are we going to see something that's been evident in the US, in the UK last week? We saw wages numbers coming out, and they were really, really strong. Are we just a quarter behind what's happening overseas? And the jury's out on that, of course. But if Dr. Lowe is wrong, and what we're seeing globally starts to show up in the next quarter or two here in terms of labour market outcomes, in terms of these wage pressures, then he may have to revisit his assessment on monetary policy. And he did acknowledge that too. He said, look, if we're wrong, and there's a probability that they will hike earlier. But all that said, the market didn't really move much. It's still pricing in the first rate hike in the middle of next year, a series of rate hikes over the following 18 months, so that when we get to the middle of 2023, the market's saying the cash rate will be 1.5%.
A long way above where it is at the moment. What I thought also interesting last week, Phil Lowe talked about inflation pressures in Australia being a bit different to overseas jurisdictions. And then you just mentioned the UK had its highest inflation rate in more than 10 years. Canada's highest inflation rate came out in almost 20 years. The US is a couple of weeks ago. That's the highest in 33 years. There's certainly inflation showing through in other economies, even if in Australia it's still fairly well contained.
Yes, and that's the big difference appears to be at this stage. There are two big differences. One, that the energy prices overseas have been a lot more robust. They've been increasing at a much faster rate than here, even though we're noticing our petrol prices going up, of course. But they've actually had electricity prices being really undershot by shortages of gas and coal and these sorts of things. So we've avoided that to some extent. The second thing, which I think is really interesting, is that, of course, they all have monthly inflation indicators. So every month you get a lot more information that there's a tick up in these prices and those prices and these other things. Our quarterly CPI, which came out just a short while ago, about 3/4 of the prices that they use, the Bureau of Statistics this is, are actually taken in the mid-month of quarter. So to get the September quarter numbers, they looked at prices in August. And so they've missed what's happened in September and October. And we don't get that reading until late January when they produce the December quarter CPI. So that's sort of not meant to be too much economist gobbledygook, but it's really just to say that there could be just a methodology issue in how we calculate our CPI and how frequently we produce it and how frequently it's produced overseas. So, look, it'd be very rare for Australia not to be following the broad trends of global inflation. It would be impossible to imagine that that's the case. It's just a matter of whether we're a quarter or two behind the rest of the world.
Well, that's last week. We'll be back in a moment and get into the week ahead. I'm with economist Stephen Koukoulas, aka the Kook. Stephen, what's on the agenda this week?
Look, we've got towards the back end of the week, Wednesday, Thursday, Friday, we've got the building blocks, as they say, for the September quarter GDP numbers, which come out next week. So we've got this week the construction work done for the September quarter, probably a weak number because we know that during the lockdowns in Victoria, New South Wales and the ACT, construction was actually hampered for quite a deal of that time. People weren't allowed to go to the building site. So expect a big negative, but that's, again, part of what we already know. So there's probably not going to be a surprise if we see a dip in construction activity. And linked to that is business investment, again, for the September quarter, probably a little weaker because of the lockdowns. However, the interesting part of the business investment numbers is the expectations for business investment in the following financial year, because the ABS asks businesses, well, how much are you expecting to invest? And that's going to be the focus of the market. So last time, the increase next financial year was around about 10, 11%. So a nice rebound and part of that recovery story that we've been hearing about before Delta came along. So if we see a similarly upbeat view on CapEx, business investment, then I think that'll be reinforcing this optimistic view about the economy. Rounding out the week will be the retail sales numbers for October. They come out this Friday. And October, the lockdowns were ending through the middle part of the month in New South Wales and Victoria and, again, the ACT. So we're probably going to get quite a strong retail sales number. I think the market's at about plus 1.5% to plus 2% month on month, which is a strong result, but again, explainable from the lockdowns ending.
Stephen, have a great week.
Thanks, Sean.
That was economist Stephen Koukoulas, better known as The Kook. You can find him at thekook.com and follow him on Twitter using the handle The Kook. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.